Everyone is looking at the wrong numbers. They see home prices and think, okay, not great, but still holding. They see mortgage rates and say, hi, sure, but we've been here before. They look at inventory, at listings, at the Fed's latest statement, and they tell themselves, this is a correction. This is normal. This will pass. But here's what they're not seeing. Delinquency rates are rising. Quietly, steadily, especially among buyers who entered the market in the last 3 years. Listings are sitting on the market longer than they have in nearly a decade. Price cuts are accelerating in markets that just 2 years ago were receiving 15 offers above asking within 48 hours. And transactions, the actual volume of homes changing hands, is collapsing. Not dipping, collapsing. And when transactions collapse in real estate, that's not a sign of stability. That's a pressure valve getting tighter and tighter. That's what comes right before something breaks. So let's talk about what's actually happening. Because this isn't a slowdown. This is a structural freeze, and it's already spreading to cities you wouldn't expect. Let's start with the places where it's already visible. The first wave hit the Sunbelt, Austin, Phoenix, Tampa, parts of the Florida coast. These were the boom towns of the pandemic era. People flooded in, remote work unlocked them. Prices surged 40, 50, sometimes 60% in under 2 years. It felt unstoppable. It wasn't. Austin has now seen some of the sharpest price corrections in the entire country. Inventory has ballooned. Sellers are offering concessions, rate buy-downs, closing cost coverage, price reductions, things that were unthinkable in 2021. Phoenix is following the same trajectory. The same markets that went vertical are now going sideways, or worse. And the sellers who bought at the peak aren't just underwater on paper. They're stuck. They can't move. Because moving means giving up a mortgage rate they'll never see again. But here's where this gets more dangerous. It's not staying in the Sunbelt. Seattle is slowing. Denver is slowing. Markets that were supposed to be insulated, stable economies, strong job bases, limited housing supply, are now showing the early signals. Longer listing times, more withdrawn listings. Buyers making lowball offers that would have been laughed out of the room 18 months ago. The slowdown is metastasizing, moving from the overheated markets into the ones that were supposed to be safe. And then there's a third category that almost no one is talking about. Mid-sized cities, regional hubs, secondary markets that absorbed migration overflow during the pandemic, places that weren't prepared for the surge in demand, that built their local economies around an elevated baseline that's now starting to crack. These cities don't have the institutional cushion that a New York or a Los Angeles has. When things shift there, they shift hard. So what is actually driving this? Because if you've been listening to the mainstream explanation, you've heard one word over and over again: rates, high interest rates. That's the story. That's the villain. And yes, rates matter. When you're looking at a mortgage payment that's 60, 70, sometimes 80% higher than it would have been for the same home 3 years ago, rates matter enormously. But here's what the rates-only explanation misses. The root cause isn't rates. The root cause is affordability collapse. And those are not the same thing. Affordability collapse is what happens when prices rise, rates rise, wages stagnate, savings evaporate, and debt accumulates, all at the same time. It's not any one of those factors. It's all of them hitting simultaneously, compounding against each other. And that's exactly what happened. During the pandemic, prices surged on the back of cheap money and remote work demand. Then rates rose sharply to fight inflation. Wages grew, but nowhere near enough to close the gap. The savings buffers people built during lockdowns? Gone, drawn down by inflation, by rising rents, by the general cost of living surge that followed the pandemic. And consumer debt? Back up. Credit card balances at record highs. Auto loan delinquencies climbing. So even if rates drop tomorrow, even if the Fed cut aggressively, the underlying problem remains. Homes are still priced at levels that are simply out of reach for the median buyer. Not inconveniently priced, not aspirationally expensive, structurally inaccessible. And that's a fundamentally different kind of problem than anything a rate cut can fix. Now add the lock-in effect, because this is the mechanism that's making everything worse. There are tens of millions of American homeowners sitting on mortgage rates they locked in between 2020 and 2022. Rates of 3%, 2.7%, some even lower. If they sell their home today and buy another one, they surrender that rate forever. They step into the current market at 6, 6.5%, maybe 7%, which means a monthly payment that could be double what they're paying now for a smaller house in a similar neighborhood. So they don't sell. They stay put. They renovate instead of relocating. They tolerate the commute instead of trading up. They hold on to homes they might otherwise have put on the market. And in doing so, they remove supply that the market desperately needs. This creates a paradox that's almost elegant in how brutal it is. Because supply is tight, not because people want to hold, but because they're financially trapped. And because supply is tight, prices don't fall as fast as fundamentals would suggest, which means buyers still can't afford to buy, which means transactions stay suppressed, which means the whole system locks up. It looks stable from the outside. It isn't. It's a system under enormous internal pressure with no natural release valve. And what about policy? What are governments and central banks doing about this? The honest answer is not much that's working. The Federal Reserve is caught in a bind that has no clean exit. Cut rates too fast, and inflation risks return, particularly in an environment where supply chains are still fragile and global uncertainty is high. Keep rates elevated and housing remains unaffordable for millions. There is no version of monetary policy that solves this problem. Rate adjustments address the symptom, the monthly payment, not the structural gap between income and home prices. On the fiscal side, we're seeing a familiar set of tools being deployed: first-time buyer tax credits, down payment assistance programs, subsidized mortgage products, and these things aren't useless, but in most cases they have a well-documented side effect. They increase demand without increasing supply, which means prices adjust upward to absorb the subsidy. The buyer doesn't end up better off. They just paid more for the same house with government help. Supply-side interventions are more promising in theory. Zoning reform, streamlined permitting, density incentives, but these are slow, politically contested, and their effects take years to manifest in actual inventory. Cities that started zoning reform 5 years ago are only now beginning to see new units come online. The timeline doesn't match the urgency of the problem. Here's the uncomfortable truth. We are dealing with a structural imbalance, not a cyclical one, not something that corrects naturally in 18 months when the market finds its floor. This is a mismatch between the supply of housing and the financial capacity of the population that needs it. And that kind of imbalance doesn't self-correct. It accumulates. Now people ask, is this 2008 again? And it's worth taking that question seriously. The answer is no, but the way in which it isn't 2008 doesn't make it safe. The 2008 crisis was a leverage and fraud crisis. Underwriting standards had collapsed. People were getting mortgages they couldn't afford, often with no documentation, on homes they couldn't have qualified for under any rational lending standard. The system was full of toxic assets disguised as investment-grade products, and when the defaults hit, the contagion spread through the entire financial system in a matter of months. That's not what's happening now. Lending standards today are genuinely tighter. The buyers who are in the market are, on average, more creditworthy than their 2006 counterparts. Bank balance sheets, while not perfect, are better insulated. But here's the other side of that coin. In 2008, the problem was that too many people were buying homes they couldn't afford. Today, the problem is that too few people can afford to buy at all. That's not a better problem. It's a different kind of crisis, slower, less dramatic, but potentially more durable. And it's not just the United States. Canada is dealing with housing costs that are, relative to income, among the highest in the developed world. Toronto and Vancouver have become case studies in what happens when supply constraints meet speculative demand over a sustained period. Australia faces similar dynamics. Sydney and Melbourne have seen dramatic price surges followed by a grinding correction that keeps stalling. Parts of the UK, Germany, the Netherlands, markets that looked rock solid a decade ago are showing the same pressure points: rising costs, declining transactions, a growing class of permanent renters who have given up on ownership not as a choice but as a concession to arithmetic. This is not a coincidence. This is a global pattern. Different regulatory environments, different interest rate trajectories, different demographic profiles, and the same outcome, which tells you something important. This isn't a policy failure specific to one country. It's a structural characteristic of housing markets in high-cost economies that failed to build enough supply during periods of low interest rates. So, where does this go from here? There are 3 plausible trajectories, and none of them are clean. The first is the slow grind. Prices adjust gradually over a period of years, not a crash, but a sustained deflation in real terms as incomes slowly catch up and rates eventually ease. This is probably the most likely scenario, and on paper it sounds manageable. But a slow grind means years of suppressed transactions, depressed construction activity, reduced household formation, and a generation of potential buyers waiting on the sidelines. The economic drag from that is real and significant. The second trajectory is the sudden break, triggered not by housing itself, but by an exogenous shock, a significant rise in unemployment, a financial institution with heavy real estate exposure that runs into trouble, a recession that forces distressed sales. In this scenario, the pressure that's been building beneath the surface releases quickly, and you get something that looks more like a traditional correction. Sharp, painful, faster to resolve, but damaging in the short term. The third path is prolonged stagnation. The market doesn't correct in any meaningful way. Prices stay elevated. Rates stay elevated. Transactions stay suppressed. The system just limps along. Low fluidity, low mobility. A housing market that technically functions but serves an ever-shrinking percentage of the population. Because here's what's already changing below the surface, and this may be the most consequential shift of all. Younger generations are recalibrating their expectations around home ownership, not as a temporary adjustment, as a permanent one. Millennials and Gen Z are renting longer, not as a lifestyle choice, but because the financial calculus doesn't work. They're delaying household formation, staying in cities not because they want to, but because they can't afford the suburban markets where a first home would traditionally be. They are, quietly and without much fanfare, building a life architecture that doesn't include ownership. And that has enormous downstream effects on everything from furniture markets to school enrollment to local tax bases. Investors are shifting strategy in response to this. Build to rent is accelerating. Institutional landlords are acquiring single-family homes in suburban markets, converting ownership stock into rental stock. This isn't nefarious, it's a rational response to demand, but it compresses the supply of homes available for purchase even further, deepening the lock-in dynamic. Developers are pulling back on new construction. Permit filings are down significantly from their peak. The pipeline of new housing that was supposed to ease the supply crunch is narrowing, because developers, like everyone else, are looking at affordability and asking whether there's a buyer at the end of this project. In many markets, the honest answer is not enough of them. So let's bring this back to where we started. Has the housing market hit a breaking point? In many ways, yes, but not the breaking point people were imagining. There is no single crash, no Lehman moment, no morning where you wake up to see prices down 30%. Instead, what we have is a system that is slowly, persistently, structurally failing at its core purpose, which is to allocate shelter to the people who need it at a price they can sustain. That's harder to see than a crash. It doesn't generate the same headlines. It doesn't produce the kind of dramatic footage that runs on the evening news. But it is real. It is deepening and it is spreading, city by city, market by market, across the country and across the developed world. And within that, there is opportunity, but it requires patience and precision. Buyers who can wait, who are positioned to move when distress emerges in specific submarkets, who understand which cities are structurally oversupplied versus which are merely repricing. They will find windows, cities that reform their zoning aggressively, that build ahead of demand rather than behind it, will attract capital and population while others stagnate. Policymakers who stop reaching for demand-side tools and start addressing the supply deficit seriously will see results. Eventually. The housing market isn't going to collapse overnight, but it is changing, permanently, structurally, in ways that will reshape how entire generations live, where they live, and whether they own it all. The only question is who sees it clearly enough to navigate what comes next.